Imagine you cooked yourself a wonderful investment dish which looks like this at the start of the year, every asset in the right proportion. But at the end of the year, surprise, your dish looks something like this: too spicy with equities or too bland with debt. And that's what markets can do to our portfolios. And portfolio rebalancing is like the chef's touch, bringing back the original flavor, recipe, and keeping your portfolio healthy. Let's say your target portfolio was 55 equity, 40 debt, and 5 gold and silver. But as markets move every day, these weights drift. And by the end of the year, your portfolio might look like this. This is where portfolio rebalancing comes in. It simply means adjusting your investments back to its target allocation whenever market movements push them off balance. Please check out these two videos if you do not have an asset allocation strategy in place. This should help you get started. And feel free to comment with your asset allocation strategy questions, and I will be glad to answer them. You can even send over email. In this video, we will cover three things. One is historical performance comparison between a rebalanced portfolio and an unrebalanced portfolio. Number two is why rebalancing matters to your wealth and risk of your portfolio. And number three, which according to me is the most important point, is analyzing the performance of rebalanced portfolio and what we can learn from them. Let's backtest this with an example of 20 years. On 1st Jan 2006, I invest 1 lakh with 55% equity, 40% debt, 3% gold, and 2% silver. This will be our target asset allocation. In one portfolio, we rebalance every year on 1st January. In the other, we make no changes at all. No extra cash flows are added in both cases. I have used the following instruments for this backtesting. Equity is 27.5% Nifty 100, 16.5% Nifty 150 mid-cap index, and 11% in Nifty 250 small cap indices. For 3% in gold, I've used Gold Bees ETF. For 2% silver, I have used the average bullion prices for the year end. For 40% in debt, I've used UTI Gilt Fund. So how do these two portfolios perform over time? I'm telling you, prepare to be shocked. On 1st Jan 2006, the split of investment across asset classes is given in the first table. Again, in 2006, these asset classes returned what you see here in the second table. A very good looking return table, isn't it? At the end of 2006, on Jan 1st of 2007, the portfolio value became 1,23,196. Now, this is the portfolio without any rebalancing. We simply let it grow on its own. The growth trajectory is shown here. By 10th of September 2025, the portfolio has grown to 10.17 lakhs. But here's the key. Compare your current allocation to your target. The portfolio is now much riskier than you planned, with only 17% in debt instead of 40% you actually wanted. Precisely this is why rebalancing matters. Without rebalancing, your portfolio risk is slowly climbing upwards without you not realizing it at all. But here's the twist. It is not only about risk. In the rebalancing scenario, the portfolio value at the end of 2006 is the same as before. But at the start of 2007, we reset the portfolio back to the original asset allocation targets. Friends, watch this closely. At the end of the year, we compare the portfolio's actual asset allocation with our target asset allocation. We sell the portions that have gone above the target and use that money to buy assets that fell below the target. For example, as of 1st Jan 2007, we sell 5,074 rupees of Nifty 100, 871 worth of mid-cap index, 1,047 worth of small cap index, and 271 rupees worth of Gold Bees. With that cash, we buy 7,044 of Gilt Fund and 220 rupees of silver. This brings the portfolio back to its target asset allocation. I know this concept can feel a bit confusing, so if you have any questions, drop a comment or send me an email. I'll do my best to respond to each one with my thoughts. So on 1st January of each year, we rebalance to keep risks under control. Now, if we manage to do this consistently for a 20-year period, this is how our portfolio will look like. With annual rebalancing, the portfolio grows to 12.89 lakhs. That is 2.62 lakhs more than the no rebalancing scenario. The takeaway is very clear, friends. Rebalancing adds real value. Over 20 years, it boosted the returns by about 1.3% per year, and the data proves it. So, balancing isn't just about controlling risk, it actually puts money back into our pockets. Friends, let's break down and understand why there is such a big difference in returns. For this, we'll break down the 20-year period into three phases. The bull phase of 2006 and 7, the uncertainty phase till 2012, and the bull phase post 2012. In the first bull run, the rebalanced portfolio slightly underperformed the unrebalanced one. It's kind of expected since we moved money into debt and silver while equities were roaring. But the uncertainty phase is where rebalancing really proved its worth. In 2008, the unrebalanced portfolio fell by 60,000 rupees, while the rebalanced one fell only by 32,800 rupees. Then came 2009, a massive equity recovery. And because we had rebalanced at the end of 2008, moving profits from debt, gold, and silver into equities, the recovery was compounded. 2011 was the only year in the whole 20-year period where unrebalanced portfolio outperformed. But why? Because 2010 was a great year for gold and silver, and rebalancing shifted money into equities, which then fell in 2011. Post 2011, the rebalanced portfolio really pushed ahead, creating the 1.35% return difference over the 20 years. The bottom line, those two uncertainty phases made all the difference, and that is exactly where rebalancing adds value. Friends, by now, I hope you're convinced about the need of rebalancing as an idea in our portfolio. It's a necessity. And you also understand how different assets play their part in building wealth for us. Are there different rebalancing strategies? What about transactions, access, costs, commissions, and so on? Those will be discussed in part 2 of this video, friends. The link of the same will be pinned in the description and the comments. Thank you for watching.